Good afternoon, ladies and gentlemen. Quality earnings continue to roll on Dalal Street, making an impact on the overall performance of the third quarter as far as the earnings potential of the country is concerned. We are now joined by Mr. Vineet Agarwal, MD at Transport Corporation of India, the country's largest logistics player, which has a multi-border presence, which is road, air and seaways as well. Let's look at the numbers. These are really good. You have a 16% year-on-year, 14% year-on-year increase in net profit to 116 crore rupees in the quarter gone by. This is both a sequential as well as an year-on-year rise. Sales have jumped 9% to 1249 crores, again up year-on-year and sequentially as well. Let's get into the details of the matter. Mr. Agarwal joins us. Namaste to you, Mr. Agarwal. A very warm welcome. Would you like to explain the jump in profit, both sequential as well as year on year? What caused it?
Hi, Shailendra. Always good to be back here. We have quarter three for us is usually when we get dividend from our JV companies, etc. So I think some of that got accounted in this quarter. Apart from that, some businesses have done quite well. Our shipping business has done well. Our supply chain business has done well. So that has gotten reflected also in the margins. And of course, the joint ventures that I mentioned continue to do well as well. So essentially what has happened in this quarter is that as you know, the GST rate changes happened on September 22nd. So a lot of movement happened in that last few days of September for the quarter end. But that momentum actually continued post the quarter end to October, November. And of course, you had the Diwali season as well. So it was all positive from our overall perspective, especially in the automotive sector, where we saw a large shift in terms of movement from road to rail as well. So typically we would do 450 odd rakes, car loads of rakes with cars and two-wheelers, etc. Every quarter. This quarter we did more than 550. So it's that 25-30% jump in terms of volume that happened, and of course some of that got reflected into the top line as well as in the bottom line of our divisions. Apart from that, we are seeing good growth in warehousing. We've been able to capture some large contracts of some FMCG companies, quick commerce companies, etc. And that has again also helped us with the overall growth. So overall, I think some factors have played well, and some factors, of course, really have, some factors are still to pick up, which is what I talked about last time, that capital goods and other such sectors are still slightly weak.
Fair point. It's a mixed bag as the management commentary is talking about. But of course, the GST rejig, especially in the auto space, as also festival demand is something that's buoyed both profit as well as top line. What now, Mr. Agarwal, how do you see the last quarter in which we are sitting, and what are the plans for the next financial year? We've seen the budget. We've seen two major trade agreements being done with. The EU one is signed and the American one is announced. What are your plans for the next 12 to 15 months?
Quarter four is usually the best quarter for us. Our guidance for the year is 10 to 12% on the top line, about 15% on the bottom line. So we should be able to reach to that level. Essentially, we had a capex plan of about 400 odd crores, 425 crores. I think we'll get to about 350, 375 crores for FY26. Going forward, I think the capex plan exists, which we are looking at would be in the excess of 450 crores, depending upon how we have visibility of new ships, etc. The FTAs, the European FTA is going to still take 9 months to a year for it to be ratified. So the direct impact is still not there, but we do believe that there are some companies who are already starting to come into India, looking at India. When we met several of them, they are very keen to participate in the Indian economy. So we'll see some of them trickling in, and that would help the economy. That will help us with creating new demand for us, both domestic and EXIM demand. Subsequently, the US agreement, when, if and when that happens, not if, rather when it happens, would mean that we would be able to again have the same impact with American companies who are coming into India. Export for many companies would mean that domestic production has to happen. So domestic production means raw material movement or some parts movement, etc. And that's where we come in. We're not so active on the international trade, but definitely from our 1500 office network, etc., we are able to bring in cargo and offer all kinds of solutions to our clients.
Okay. Mr. Agarwal, what's an interesting thought to pursue further is the automobile space. You transport everything from auto ancillaries to vehicles right down to the showroom. Now, what have vehicle manufacturers told you about fresh capacity coming on stream? Why I ask this is many naysayers are saying that the 3 months post the GST rate cut on automobiles was a one-off kind of a quarter, and now you will see demand tapering off. How have OEMs communicated to you as far as their next 15 to 18 month plans are concerned? Will their shipments rise?
So what we are seeing is that Q4 will continues to be robust.
Okay.
And for us, we manage about 70 yards for our clients across the country in the automotive space, whether it is 4-wheelers, 2-wheelers, 3-wheelers, commercial vehicles, earth-moving equipment companies, tractors. So we are the whole gamut of auto and mobility space. So essentially what we are seeing will happen is that some sectors in the overall automotive space will keep moving up and some will keep moving down. For example, we've seen commercial vehicles do reasonably well this time, which did not do so well earlier. Or we've seen two-wheelers have had a good impact growth also. And two-wheelers tend to also follow festival seasons, marriage seasons, etc., etc. So they have their own dynamics at play, including transition to EV. We are seeing a large transition of EV from the two-wheeler side. So some of these dynamics at play. So I think that some pent-up demand was absolutely there, and the GST cut helped to capture some of that. But there remains a certain level of momentum. And that momentum is followed by GST cuts, interest rate cuts, consumer sentiment demands, new product launches, and essentially there's some hopefulness that the sentiments are better, so let's look at some capex at the family level. So broadly speaking, we are relatively positive, and as you rightly said, we are on all aspects of the chain. So when there's domestic production happening or production happening for EXIM, we are involved there as well. And if there are spare part sales that are happening, if the car sales are not happening, we are involved there as well. So we are able to cover the whole gamut, and hence we are quite positive on the auto sector.
To our viewers, let me just add that over the last 23 years that I have tracked Transport Corporation of India, there is no better indicator about the health of the economy than the performance of this particular company, because very simply, right from raw materials that comes into ports, reaches factories, finished goods that leave factories and reach the consumer, TCI is involved in the entire chain from head to toe, which includes warehousing, which includes logistics, which includes transport to a very large extent. Mr. Agarwal, coming to the breakup of the business, seaways, roadways, railways and supply chain. Seaways performed the best, very high margin performance, closer to, I think EBIT is closer to 40% there. What prompted this very sharp uptick in both sales, profit and profitability at Seaways?
Actually, Seaways has been maintaining its profit levels at about 40-ish% EBITDA levels. Revenues have not grown too much because we've not added any fresh new capacity. We operate 6 ships, and they're all container ships on the coastal waters of India. And some of the ships, 3 ships went for dry dock so over the course of the last 9 months, and they are now working at full capacity. So revenue uptake has not been there, except for sometimes if the selling rate increases a little bit. But the margins have been maintained because the ships are older. We've been able to depreciate them, as well as with international freight rates being slightly on the uptick. That has also helped us. Of course, now we are seeing in quarter 4 that container prices rates are coming down globally. So we are hopeful that we'll be able to maintain not necessarily the 40% EBITDA, but at least between 30 to 40% levels. Going forward, we have 2 ships on order that should come by FY27 Q3, and that the impact of that will be seen more on Q4 FY20.
Okay, fair point. The 400 crore capex that you plan for the next financial year, how is it going to be spread over the 4 main businesses?
Well, essentially, half of that is probably going to into shipping because of ship orders that have been placed, and we've only given the advances so far. The final payments will be due in the course of the year. Then about 100 odd crores will go into trucks and car carriers, for rail car carriers. In fact, we've ordered for 2 rail car carriers as well. That should come by the end of this calendar year. And of course, new trucks. So we're also looking at some EV trucks. Then about 100 odd crores into warehouses and hub centers. So that's a little bit of a broad breakup in terms of what we're looking at capex.
Okay. Could you share some details about how exports slowed over the last 6 months or so because of this issue with the US? They are our largest trading partner. And what signs, I mean, it's really too early, the deal is yet to be signed, but have exporters been reaching out to you?
Yes, US is the largest from merchandise plus services combined. I think if you look at merchandise only, then of course US is large, but there are other countries also that are large, and we've seen that a lot of exporters have diversified their export destinations. So that has been positive. I think that will augur well for next year, when not only will these FTAs come into place, but also the fact that they've been able to diversify. So when we speak to exporters, they're very gung-ho in terms of how things will reach out. And remember that the rupee is helping them. It's not helping the imports, but definitely helping the exports. So given all of this, I think the export market is looking good. Of course, global geopolitics has a lot to play here. But India can substitute several other countries with its competitiveness. Now we're seeing that more and more. So there seems to be a little bit more positive outlook when it comes to exports from the exporters.
Fair point. With that note, Mr. Agarwal, we'll call it time, and we look forward to welcoming you as always in the next quarter. Meanwhile, a Happy New Year, and here's wishing you all the best.
Thank you. Same to you.
That, ladies and gentlemen, was Mr. Vineet Agarwal, MD at Transport Corporation of India, the nation's largest logistics mover. Thank you for watching. There's more that's happening on the other side of the break. Please stay tuned.
Changing faster than ever before.
At the heart of it, 5 forces shaping tomorrow.
Power,